Hello and welcome to Trading the Trend. My name is James Boyd. Happy Thursday to you. Hopefully wherever you are, you got some nice weather. We were over 70 here yesterday in Salt Lake City, and that grass is growing. So hopefully the portfolio is as well. We'll take a look at that in just a moment. We'd like to welcome Mehdi, SBG, Silas, and many others. Welcome to all of you here today. Quick heads up, Jax, he wanted to co-teach with me today. I told him that he could not co-teach with me today, and I've never seen him do this. He kind of closed his eye, and there was like a little tear in the corner of his eye. So if he come barging through the doors, we got a co-teacher here today. So anyway, a little fun there. Now, let's go ahead and get started. Now, also remember that with what we discuss here today, it's done for informational purposes only. When we talk about stocks, but we will also talk about options, remember that options carry a high level of risk and are not suitable for all investors. Also, when we talk about examples, we will do those on the Paper Money software application for educational purposes only. Investing involves risk. That's really what the manager, the investor is trying to focus on. Try to make a return, but the main focus is risk first, and then return second, okay? But it's really trying to say, what's the capital outlay? What are we potentially risking? It's a defined risk, or it could go all the way to zero. What is the risk? If you can't identify what the risk is, maybe it's time to slow down and kind of maybe think about, do you understand the strategy that you're choosing? Also, remember when we talk about short options, those could be assigned at any time up to the expiration, regardless of the in the money amount. Those are American style options, okay? Remember that option Greeks measure sensitivity to something. We'll talk about that. And also remember that today we'll take a look at where the markets are. We'll kind of mention a couple futures. We won't look at the futures charts because I can't show those, but I'll also actually just kind of speak to them just real quick. We'll talk about indexes, sectors. We're going to look into a couple of positions that we need to talk about, okay? Stock and option positions, and then we're going to talk about some new examples. Now, if someone were to ask you just real quick, what's something that has stood out to you today, what would you say? Is there anything that if someone said, what's going on in the market, what would you say to them? Now, as I'm getting kind of a quick answer to that, when I look at the SPX just for a moment, the SPX level that we need to hold if this kind of recent breakout is going to kind of have kind of maybe potentially still some legs to it, 56.75, okay? This is the second day that we've actually gone down. Earlier today, saw a little bit more of a rally, did not hold that. We're sitting right back down. Now, if the S&P is kind of down like this, it probably tells us some sectors up, some sectors down. It's kind of getting a split here, but not everything is the same. That's an important point to pull out, which means we're going to have skill to really be able to read the charts and also kind of make a comment on a couple of stocks that probably aren't going up. And as we mentioned yesterday afternoon. Now, when we also look at just real quick the VIX is at 1878, okay? Notice anything on the VIX. Now, in the last day or two, probably 2 days, been kind of more bashing around regarding tariffs, okay? Auto tariffs and so on. That kind of push the volatility up a little bit. Don't like to see the VIX level getting above the moving averages. Don't want to see, obviously, now we're kind of thinking at this point, what's the chance of the moving average crosses? The answer is pretty high, okay? So if we start to see the VIX getting back above the moving averages, if we do, stop on current positions, right? Stop adjustments. Making sure that the positions are managed appropriately, right? There could be, in this little run that we've actually had to the downside on the VIX, there could be some opportunity that some of the positions might have some profits there that might be reaped and harvested. So we want to make sure that we're kind of paying attention. So the fact that the VIX is getting above the moving averages, that kind of means that some of the stocks might be pulling back. We want to be made aware of that. Now, when we also take a look at Villager actually says silver, for example, hitting a brand new high, at least shorter term. Silver trading over $35 an ounce, okay? Gold traded almost at or near, okay, $3,100 an ounce. So this dysfunction that we've seen lately has led, and I've never said this before, okay? The precious metals, and I'll include copper, okay, gold, and silver. It feels like it's becoming the new sector, okay? The precious metal sector. I'm not talking about palladium, not talking about platinum, but copper, gold, silver. You kind of feel like that's a place where some investors are hiding a little bit, if you will. So, and by the way, copper, I think yesterday hit a brand new high internight. Gold, literally 3,100 an ounce. It was pretty shocking, okay? Just kind of makes you glad that you already have your wedding ring already. I'm just thinking of that because my son's coming. He's coming back home in about 4 months, and he has a nice girlfriend. And I told him, I said, man, you better make sure you have as much money as possible to buy her a nice ring because it could cost a little bit more. So, all right. Now, the other thing to kind of keep an eye on is crude oil, okay, and gasoline. We talked about that. And the other thing I want to kind of at least make mention of, it seems a little interesting that if things were getting just worse, why would the TNX be going up, okay? Why would rates be going higher? That's something to continue to watch because if things are getting worse and worse and worse, you should be seeing rates go down, not up, okay? And this is kind of what we kind of said before is if things are so bad, then they think it's going to be bad like that for months. Why is copper going up, okay? Second thing is here is if we see rates go up, they actually think that maybe the economy might be stronger than we think and they want a higher return for what they loan money for or into who, okay? So that's something to keep an eye on. Super quick on the sectors. Staples, getting a little push here, okay? Any stocks in the staple space that you have seen. We mentioned this yesterday, Coca-Cola, Monster Energy Beverage, and a couple others. Now, normally, okay, if the VIX maybe starts to do a divergence, sometimes you can start to see staples get a little breakout to the upside, staples moving a little bit, okay? Now, if we pull up, let's say, discretionaries, are the discretionaries just falling apart? I can't say they're falling apart. They're still holding pretty good. We'll look at Amazon in just a moment, among other areas. And if you look at the financials, holy blasted Visa and MasterCard, okay? We cannot say that financials have fallen apart. You look at the higher low at 608, we are still trying to form another higher low. Hasn't done that yet, but overall, that's still intact to actually try to get a reversal. Where did it break down from? 625. We're still quite near there. Some of these financial stocks, they're holding, okay? And if I just kind of look at one real quick, you're seeing that Visa, okay, your classic 1 day down, bounce right back, 1 day down, bounce right back, 1 day down, bounce right back. It's not Visa. And Visa is kind of, for example, recapturing where the breakdown was from. It's not just Visa. You see MasterCard, doink, okay, right into that area of 558. And by the way, will someone tell Berkshire Hathaway to stop going up? Okay? Like Warren needs any more money. Okay? We know he's not putting the money in the house. We know that. Okay? If you've ever seen the house in Omaha. But if you take a look at that, it's at a 52-week high. Okay? Go figure. Okay, now, I also want to, for example, take a look at a couple Dow stocks. Just kind of, let's look around together here, okay? Verizon, okay? We know that not everyone's the same. There's some people that maybe have a pile of money and they want to use the money to maybe try to get potential dividend paying stocks. Okay. Now we know with dividends, they're not guaranteed forever. Okay. They could raise the dividend, they could cut the dividend, they could keep it the same. It's moving. Now, if you take a look at, let's say, Verizon, that's a little squeeze breakout. Now, it's not just Verizon. We talked about T-Mobile yesterday. And if you look at this is a little squeeze breakout on Verizon here. If you go take a look at AT&T, you're going to see doink, brand new upside. And that was about as classic flag that you can get. The little moving average crossover about a day or two before the diagonal breakout. And it's been just kind of marching away. Remember, when you're talking about buying some of these stocks, some of the stocks you're buying, you're not buying them because they have the biggest growth potential. You're buying them because of the trend and that you think it could go up. And if you get the dividend, that's just icing on top of the cupcake, okay? Now, when we also, so that's that. And then we also take a look at, let's say, what about T-Mobile? Okay. T-Mobile, it's up a couple bucks. Okay. The most significant is not that it's up 384. What's significant, it's breaching that old horizontal area of support. And if we get above that support about 262, the path of least resistance, and this makes the bears pull their hair out, because all of a sudden they're like, wait, I thought it was going down. And all of a sudden they don't admit when they're wrong, and that path of least resistance might try to be, let's say, 270, maybe 272, and so on. Kind of that's been one that's kind of turning around too. So notice kind of seeing a little shift in what some investors are buying. Now, does that mean Apple's going down? We'll look. Does that mean Amazon's going down? We'll look. Does that mean Tesla's going down and it's horrible? We're going to look at it. So just kind of seeing a little shift here in terms of what people are buying, okay? Now, here's the, James L. says, run to Staples. Well, so we're not saying in terms of an overall portfolio that we're going to bank the portfolio on Staples, okay? Remember, if we remember, we're going to tend to have about 5 sectors in the portfolio, all right? Now, let's just kind of make this perfectly clear, okay? So we're going to try to have like 5 sectors. Now, obviously, if we're trying to grow the portfolio maybe greater than maybe what the S&P does, clearly we're going to try to maybe kind of look for opportunities in K for technology, Y for discretionaries. That's where you tend to get the growth, sure, okay? Now, when you look at these other areas, maybe let's say I'm going to also include energy and materials, and I'm going to include industrials. Those are kind of what we would call mid-beta areas, minimum to higher beta. You go look at the energy and material stocks, they can move, okay? Below that, what you're now going to notice is let me go F for financials, okay? Financials might be a beast just unto themselves. And if you look at, let's say, the U for utilities, V for healthcare, R for staples, and then RE for real estate, okay? So kind of think of these like in terms of silos, okay? Just put little dividers. Now, does that mean that the investor has to be in utilities, healthcare, and staples and real estate? No. But they might choose 1 or 2 of those sectors over here to say, are there some trends in there? But if they're trying to really go for growth, they're going to look for these areas right here probably more first. But understand, sometimes when growth is slowing, or maybe some of those stocks are under pressure, there might be kind of a focus by some investors, but don't think about just some investors. Think about portfolio managers that might kind of steer their clients towards certain pockets where they think those funds might have a better sustainability in terms of holding value and creating income for their clients. Okay, now let's kind of talk about this. What I want to do is let's go back to just real quick one of the stocks, and I want to go back to just real quick Visa for just a moment, okay? Now, if we look at Visa, okay, if we're kind of in an environment where the investor says, James, I kind of think the market is going to be more volatile, okay, and or more volatile. And remember, let's go back to our Delta scale. We know that if you play golf, that not every club in your golf bag has the same distance to it if you hit it correctly. If I take a driver versus a putter and we swing them, okay, the putter's not going to go as far as the driver, or at least it shouldn't. And if it does, you have problems, and I can't help you, okay? Now, let's say the investor says, I'm going to buy 100 shares of stock. That is the most aggressive strategy you can do in terms of Delta, and it actually has the highest capital requirement, okay? Now, I think of it like buying a stock like you are doing the driver, okay? You think you're going to cream this ball right off the tee and smash it right down the fairway. Now, I don't know how that feels, but let's just imagine. Now, in this environment, if we kind of think maybe the market might move more and stocks might move more, we're not going to do, let's say, zero Delta strategies, maybe like iron condors. We're probably going to be closer to the left, and we're going to focus on short put verticals and long call verticals. Why? Well, because we think there's a greater chance of these stocks might kind of struggle to have a consistent trend. Now, this class is trading the trend. Well, sometimes the trend can be sideways. Sometimes the trend can be almost like swing trading, etc. So if we chose a short put vertical or a long call vertical, that delta is probably going to be about 10-ish. Okay? So we are, now, by the way, go back to the golf club analogy. What would we really call a short put vertical or a long call vertical? We would kind of think of this maybe like an SW. That's a sand wedge, ladies and gentlemen. So it has more kind of like, it has more loft to it, not as much distance, okay? Or at least it shouldn't. You might be the rare exception. Okay? Now, here's the thing. If you talk to stock investors only, they're only doing stock. They're going to tell you, man, its portfolio's been all over the place. Why is that? Well, because they're swinging around with a whole bunch of drivers, okay? And they have more capital invested. We're going to kind of focus a little bit over here and kind of say, look, we're kind of thinking that it could chop around a little bit, try to choose strategies that are not as sensitive to direction. So here we go. Strap it in. What we're going to do is going to go to the paid money account. What I'm going to do is going to go back to, we're going to do this in both accounts. And if you don't mind, I'm going to kind of like put the gas down here, okay? Next week, I will not be in town. And so I want to kind of put some positions on that might have, we're going to try to see if we can't hold them through the time I'm not even watching this portfolio. Now, what I'm going to do is I'm going to go to the May expiration, okay? Here we are on Visa, okay? And what we're going to do is we're going to go look to sell the 340, okay? We're going to sell the 340. Let's just verify kind of what the open interest is, okay? Now, bid-ask spread about 20 cents wide, almost 1,000 on the open interest. So there's some liquidity here, at least currently. I'm going to right-click on that 340, sell vertical. And now what I'm going to do is I'm going to, on this type of trade, since I'm in the margin account, we're going to do one contract in the margin account, okay? And if we take a look at, let's say, what's the max loss given one contract, we're going to do about 2 contracts in the IRA. Now, people talk about kind of doing different types of things and different types of accounts, maybe. A lot of investors think, well, if it's good for one, why can't it be good for the other one? Okay? So what we're going to do is go to down where it says single account, go to multiple accounts, okay? And if we go to margin and the IRA, we're going to shift to 2. Now, total 3, and you're going to see that there. This right here, max profit, given the vertical, and that is going to be for the 3 contracts total. Buying power effect is really the max loss, and that's a max loss given actually 2 contracts, okay, of a vertical. Now, what we're gonna go ahead and do is send this order. Now, the one thing I do want to do is kind of go back to this just real quick, is I want to talk about a past trade example. Now, you guys and gals know that about 2 weeks ago, we talked quite a bit about, now, by the way, make sure that when you do a trade that is sent to both accounts, what it does is at the very top, you will see, it will say total all accounts. If you want to say, I want to go back to the IRA account or whatever account you have, I'm going to go back to the IRA account, and what it does is it loads that portfolio. Now I'm going to go back to the monitor tab for just a sec, and the one stock I want to look at for just a second is ExxonMobil, okay? Now, ExxonMobil was purchased at $111.79, and here it is right there at $117. Now, the one thing I just want to double check for just a second. Now, we know that scripts that aren't guaranteed for accuracy or timing, you want to verify those. But one thing I want to kind of do is I want to pull something up just real quick if I can. And I want to, for example, just look at where this stock is and just see if there's anything we need to consider. All right. So first off, when I look at, let's say, X, it's in trend 3, okay? The whole moving average, we're up, okay? And I want to go back to the chart, and I want you to kind of tell me, is there anything that you would consider if the stock was right here? Anything you would consider? Now remember, you got 100 shares of stock in the paid money portfolio, okay? Now what you're going to notice is, and we just got about $6 ago, if you go back and look at this, what you're now going to see is we're kind of getting into an area where there's been some consolidation, Now you got shares, you got 100 of them. What type of strategy do you tend to focus on if you're getting to an area where some investors might sell? Well, you probably thinking, hey, number one, could I sell some of the shares? Yes, try to. Could you sell all the shares? Yeah. But maybe you don't want to sell those shares of ExxonMobil because you think the group might go higher. But I want to kind of teach to a point here. If we had 100 shares of stock, what could we do to lower the sensitivity if that trend were going to pull back a little bit? Well, number one thing we could do is we could sell a call. Well, if you have 100 shares of stock and you sell a call, that's probably going to make your delta about 60. Because when you sell a call, that's negative delta. And what we're going to do is we're going to kind of think, maybe could this stock pull back a little bit? Could there be a couple bears out there that try to whack this stock down? Now, if we take a look at this, if we go to the May expiration, okay, we're going to go to May. We're going to go out a little bit and we're going to sell the out of the money call. Now, this is a good learning lesson, okay? If we sell the 120, that means we make from 111.79 there up to 120 there. So about $8, $8.21. Plus, if we agree to sell those shares at 120 from now until expiration, not just expiration, we're going to actually also receive or try to receive the credit of 279 because you would not agree to do something for nothing. Okay? So if we wanted to sell the call only, we're going to click on the 279. It loads this. Now notice this is called legging into a covered call. Legging into a covered call just means we have the shares already. We're selling the call where we think maybe that stock might consolidate. If you really thought the stock was going to fall apart and completely crash, you'd probably say, James, I'm going to sell the stock. Okay? Now, by the way, when we pull up, let's say that sector, IXE, is the sector crashing down? Can't say crashing down, but it's up as well. Little profit taking in that area, but not pulling back yet. The one thing we might kind of say a little bit more negative is those moving averages are starting to pinch on each other, which might mean there might be some profit taking within the space. So just keep an eye. Now, speaking of that, on one of the positions we have, the cover call, we're going to sell the call. Notice we're selling it higher than where it is now. Now, when we do that, or try to do that, we're going to move to 283, confirm send. And now what I'm going to do is send that order. Now, I want us to pay attention to what happens to the delta on the position. And I'm telling you right now, I think this is where a lot of people kind of struggle. They don't really understand that you can alter the position based on what you do with it, okay? Now, what I'm going to do is let me come down to this XOM down at the bottom. Where did you go? Right there. And I'm going to put it in that stock. I'm going to put it in the covered call group, okay? Right click on XOM. We're going to move it to the group. Let's go cover calls. And there she is. Now, cover calls. Here we go. So there's 100 shares of stock. And now what you're going to see is we sold the call. Notice positive delta means bullish position, sensitivity to profit or loss. Stock goes up $1, we're up $100. Stock goes down $1, we're down $100. Unrealized loss. And then what you're now going to notice is the short call. Well, it's negative delta. Stock goes up. That call should become approximately about 43 cents more than what it was sold for, approximately, could. And then if the stock were going to go down, the call premium should reduce by approximately 43 cents. It's a model, okay? It's not exact. So now when we take a look at the net of those two, the position, net, delta, is 56. So if the stock went up $1, we wouldn't make $100. We'd be up about 56 bucks. Why? Because the shares is bullish and the short call is bearish. So you reduce how bullish you really are, okay? And you've also placed a cap on the position in the shorter term. Now, what I also want to do is, so if we take a look at this, the understanding of covered call is the first learning lesson of how do you try to alter your delta as a stock trader. Why would someone reduce their delta? They think it's probably going to flatten out and or pull back. They're trying to also collect a premium to create some income. Now, the income could also come from the dividend on the stock if it pays it. And the second form of income could be the cover call premium itself. The cover call is the first stepping stone from learning how to protect your position. Cover call is not a protective strategy, it's an income strategy. Okay, always remember that. You don't have a right to sell like a put. You have an obligation to sell the shares at 120. Now, here's what would be nice, okay? If someone from now until expiration, let's say next week, took the shares at 120, we get up to the 120 plus all of the premium, even though we're not at expiration. Not counting on that. That could happen, though. Now, if we also go back to something just real quick, I want to go back to just real quick on the Apple front, okay? And then I want to take, so let me kind of just show this just briefly, okay? When you look at, let's say, Apple, that's, believe it or not, it's kind of held in there. The last higher low that we actually had was right there. How do we know that? Well, we said yesterday, we've said before that, you circle the red and green candles, and then draw the line from the open of the green candle. And so far, Apple is still holding, okay? Now, so no change there. We still have that position. If we look at Amazon, is that still holding? Where are we watching to see? Well, the breakout or the reversal happened at 196. It went from 196 on the diagonal breakout and it went up to 205, and now it's gone down for a day and it's trying to make a higher low. We're going to circle the red and green candle, draw the line from the open price, and say, look, if we can get today to hold, today's open price really becomes that higher low marker, okay? So even though we're talking about some of these discretionary stocks, they haven't completely fallen apart, okay? Which is a good sign, okay? But that doesn't necessarily mean that we're going to be blind to the levels of potential support. Now, questions have also come up on Tesla, okay? Now, why do people talk about Tesla? Well, so we had the tariffs discussion yesterday, and anything that's not, built in the U.S., a 25% tariff, okay? So you can take that with however you want to take it. Tesla broke out of the diagonal line. Now, by the way, that diagonal line, if we go from where it was, in just about a 3 to 4 day period, okay? Just from that open price to that closing price, the stock only went up 22% in 3 trading days. That's why sometimes diagonal breakouts can be so vicious and violent for bears, okay? Because when that trend reverses, it doesn't a lot of times take very long to do some serious financial damage if they're short, okay? And that's why you hear them kind of groan so much that they can't believe it because they're frustrated and they're still short and they're anchoring themselves to what they think in their mind. Not what's on the chart, but what's in their mind and their two buddies are saying, okay? Now, I want to go back to just real quick to the trade tab for just a second. The other thing why someone might kind of try to trade something, and I want to kind of show you this on purpose. Let's say someone said, James, I want to do a trade on Tesla, but I want to kind of change how bullish we really are, okay? Now, it's still going to have an obligation, but what I'm going to do is I'm going to go down to something like a lower strike. So here's where we kind of have like a non-basic understanding. We could try to sell each one of these strikes. Why would someone sell a lower delta strike? Why would they do that? Well, if we pick a strike that has a lower delta, we're probably trying to do it for the income of it, okay? And not the stock ownership part. Not that there's not that obligation, but we're trying to do it for the income part, okay? Now, if we said, hey, we're going to sell a put, I don't know, let's say the 260. If you sell, if that strike is close to the current stock price, you're really doing it for a hybrid. I don't mind in being long the shares of the stock. Second, I want the income, I want the premium. Okay? Now, on this, what I'm going to do is I'm going to go a little bit more shorter term. Just kind of want to double check something. If we went down to a delta, I'm going to stick with the Mays, okay? If I look at the Mays for just a moment, let's go back to that, and I'm going to pick something like a 10 delta, okay? So if I look at the May 220s, excuse me, not 220s, 200s, statistical chances of being below that strike is 11 by a penny. There's an 11% chance to close below there. And if we said, well, what's the probability of touching that? Now, this is very important you understand something. If the stock is more volatile, if the market is more volatile, there's a 32% chance as of right now, which that's not set in stone either. Time changes that, volatility changes that, and so on. There's a 32% chance the stock can come down to 200. There's an 11% chance the stock could close below there by a penny. So what are we saying? It's just like my favorite show. So you're saying there's a chance. Oh, sorry, that's my favorite line. Now, if we take a look at this, I'm going to go ahead and click on that 200. Now, when we talk about buying a put below that, okay, we're going to right click on that, sell, and we're going to go to vertical. Now, the dangerous thing about selling pets is the obligation, okay? That's really the thing. If that stock starts going down, the delta becomes bigger and bigger and bigger and bigger and bigger, and the investor could actually be assigned the shares to buy at the strike price from now until expiration. What we're going to do is we're going to widen the strike out a little bit, and let's say we did something like the 180. This is not your typical mom or dad's vertical spread, because a vertical spread would have tighter strikes typically. By buying that lower put just in case, a bullish investor is saying, hey, look, there's risk here. There's risk. So we want to try to reduce some of that risk. Now, what this is doing is when you buy the put below, it's lowering the credit. Guys and gals, a lot of people like trading rules, and they want to kind of hear that, oh, when we sell the put with a delta between 30 to 40. Are we saying that market conditions are always the same? If the market conditions are different and the market's just more volatile, we should have the understanding to think outside basic rule sets. If the market is more volatile, the investor might say, you know, James, I'm going to choose a strike that's even farther out of the money given the volatility. Now, as investors and traders, we're thinking, not just a little sample rule set. That's just a basic tell me what to do sometimes. We're now thinking. The rule set gives us a starting point, but what we want to do is get past that and say, hey, the market's more volatile. I might even go farther out of the money and have a lower delta. That's the type of understanding we need, okay? We're going to go confirm and send. Notice that actually we get the break even, given this short wide put spread, maximum profit, maximum loss. Now, how does it get to maximum loss? That stock needs to close below 180, okay? Now, you also got to think about something is, what is the statistical chance of closing below 180? 6% chance. 94% chance stock closes above as of right now. When you take a look at this, that gain to the potential max loss, think of the comparison as if you bought shares of stock, what are you trying to make versus what you potentially could lose. Do not assume that because you set a stop that that's going to guarantee an exit, because it's not, okay? It's a trigger to sell. So a lot of people don't even, I think that's really a big misconception. Why would I ever do a cash secured put if the max loss is so much bigger? Compare that to a stock trade, okay? And you probably wouldn't ask that question. I mean, if you truly compare, okay? The difference in the cash secured put, the short wide put vertical spread, that is a defined risk. And the stock investor is taking a lot more risk than that, okay? When you really think about it. Send the order, there it is. Now, other questions, okay? Now, yeah, that's true. He's so bitter. Okay, now,
I want to also go back to just real quick, just kind of a couple stocks that we're going to keep an eye on. Starbucks, okay? One of those stocks has had a pretty good drop down. It's kind of made like a slanted down bottom. We're going to keep an eye on actually Starbucks, okay? So if this market can actually hold these support levels we really talked about, Starbucks, keep an eye on that. It's an example, not a recommendation. The other one, if we also take a look at this, is if we take a look at, let's say, a stock like Costco, okay? Now remember, does Costco have times where it pulls back? It sure does. Does it have times where it pulls back? You better believe it. Did it pull back here? Yeah. But the biggest actually thing is, another one we want to kind of keep an eye on is Costco. Now, one of the comments is, sometimes you have markets that are more volatile. Okay, sure. I'm not sure if that's a new idea, but sure. You want to also kind of think about the stock market like business owners. If you ask business owners, if you had asked real estate people, do your markets, are they ever volatile? Are there certain things that you have to deal with in the economy to kind of go through different business situations? And I think that those people, business owners and real estate people, would say, well, duh, okay? So in the stock market, we have some similarities to business owners and real estate people. The one major difference is the stock investor or someone who trades options can change their exposure or define it. That's huge, okay? Now, what I'm going to do is on Costco for just a second, and this is also where we want to have some understanding of picking. Let's say the investor said, you know what, James, why are we talking about short wide put spreads or short put verticals? Well, we're trying to play lower delta strategies where it's less sensitive to price movement. We're trying to also have greater probabilities that we could be right. Now, if we were kind of in a market where the volatility was lower, we might kind of pick a sold put with a delta 30 to 40. That might kind of be more your standard starting point. But if we know and acknowledge the market's more volatile, we know that, and we think it could still be that coming up in the next month or two, then we can actually try to alter. We could pick the same strategy, but select a different strike, okay, for the purposes of trying to change the probabilities. Now, what I'm going to do is just like we did it before, but maybe not down as far. What I'm going to do here is I'm going to try to sell something maybe like a 20 delta put. Now, if we sell a 20 delta put, we actually have, in this case, 20 delta. 20 delta, again, is saying the change in the option price given a $1 change in the stock price. If we actually said, well, James, with greater volatility, what does that do? Well, what you're going to notice is when you have a more volatile market, you're going to see that there's a greater probability of touching. What does that even mean? Well, that means that there's a greater chance that the stock could come down to the 880 level after we get into the position. That means that there's probably a better odds of us being down maybe sometime from the time we get into expiration that we could be wrong in the short term. Now, chances to close below the 180, 20% as of right now, okay? Now, what we're going to do is I'm going to make this more of your, like a classic, maybe a little tighter short put vertical, okay? Sell vertical. Now, if we talk about a classic short put vertical, $5 wide. Classic short put vertical, maybe like say $10 wide. Now, the goal here is if we're talking about doing this in the IRA, okay, we're trying to also kind of go back and do, now you got to understand there's pros and cons here. When we do something like this, it's going to make the ROR less. Why? Well, because you have greater odds on your side, okay? If we said, hey, we're going to take 170 divided by, let's say, 830, it's going to give us a 20% return on risk. Now, for many investors, that's the floor of what they're really looking for, okay? Now, you can decide what the floor is for you. But many investors said, James, I'm not willing to take anything less than that because I got to be compensated for the risk, okay? Now, the biggest thing is when we actually went back and actually said, well, what delta is this again? Remind me. The answer is it's a delta of 20. Okay. If we look at this right here and said, what's the statistical likelihood as of right now, they could be in a max loss situation, which still could happen. Answer is 17. Okay. Now, my last trade here that we're going to kind of do and close here is we're going to sell the 880 and then buy the 870. So today we talked about a lot about probability, and we talked about why we're trying to choose kind of strategies and or strikes that have greater probability. We also brought up the point that with short put verticals, they have lower break evens. When you have lower break evens, you don't need the stock to move as much or at all to break even. That's a major point, okay? So I'm going to go ahead and send that order, and I'm out of my time. Now, if we take a look at this, if we went back and said, is it breaking support now? Okay, now if we said, is it breaking support now? We would say it's trying to make a higher low now. Okay, that's what we would say there. Now, I'm out of my time here today. I want to thank you so much for your comments and your participation. I will be out next week. I will be Xing or tweeting while I'm out with Jax. And also stay tuned for our next webcast coming up right at the top of the hour. I want to thank Brent Morse for answering those questions in chat. And thanks to all of you as well. Go out and practice these higher probability type trades. Also remember that on Friday, Brent Morse talks about advanced options, talking about higher probability type trades with lower delta. I think that's actually a pretty important topic right now. So with that said, this has been the class on trading the trend. Sometimes that trend is sideways, as we talked about here today. And with that said, stay tuned for our next webcast coming up next. Take care. Bye-bye.